Hello, my name is Steve Earle, CEO of Done For You Real Estate USA. As the days and weeks begin to creep by, as we stay sheltered in place and quarantined, you may be trying to get a handle on what's happening in the market and might be starting to ask yourself some difficult financial questions. We wanted to make a quick video that might give you some answers to some of the questions we think you might have. I want you to know that my thoughts to some of the questions we will discuss are based on real-time updates we are receiving from our teams throughout the country. I've been having daily discussions with our agents who directly deal with the properties that they find, the property managers and the tenants renting the homes, and our acquisition directors living in the various markets who are continually analyzing the news and data. I hope you will watch this video to the very end because each question posed is important to understanding your options and opportunities as a real estate investor, including one of the most important questions based on the current economic situation: am I going to be able to collect rent this month? Now, for those of you who are new to DFY, we are a residential real estate investment company that has been successfully helping our clients acquire cash-flowing single-family investment properties in different cities and states around the country since 2008. As such, we have more than 50 plus members of our team in 6 states currently helping Done For You clients buy, rehab, manage, and sell out-of-state investment properties. Besides all of the traditional research DFY is constantly engaged in, we are also in constant communication with our teams on the ground in each market where we buy investment properties. This real-time data and information has become critical to us and our clients as we try to navigate this unprecedented time in the history of our country and the world. People have been using the terms new normal and post-pandemic to describe the fact that no one is completely sure what things will look like when we're on the other side of this crisis. As such, we are looking at what is actually happening, boots on the ground, as much as we are looking at historical patterns would tell us should happen based on economic indicators. So today, there are 5 main questions I'd like to touch on. We will keep fairly surface level for now, but we believe these 5 questions are ones that you might be interested in and feel are currently important as they relate to investing in real estate. Number 1, investment timeframes. More so now than ever before, real estate is one of the safest places you can place your money. However, it is critical to understand that real estate is an ownership investment and you need to look at it as a long-term decision. If you're considering buying real estate to hold for a short time frame, you shouldn't be buying right now. In other words, if you're looking for a short-term financial gain and trying to invest money today that you may need in the next 1 to 5 years, you should consider a different investment. In today's economic environment, I can't tell you whether home prices will be up or down a year or 2 from now, but I can tell you that over the long term, real estate has always gone up, and that even in this uncertain time over the long run, we can expect prices to continue to increase. However, it is more important than ever to ensure that any property you invest in needs to have a strong cash flow projection to ensure that you have a successful investment today and in the long run. Number 2, property type. When buying a cash flow investment property, we believe in purchasing slightly below the median priced, middle income neighborhood, built post 1980, 3-bed, 2-bath, 2-car garage type home. When looking at a bell curve of most easily rented, bought or sold homes, this description falls at the top of the curve. This is the safest and most easily cash flowing property available. In our current economic situation, you might come across what seems like a home run opportunity. If it does not fall within the box I just described, I would suggest you think twice before jumping. For example, if you find a deal where you can buy a $2 million home at 50 cents on the dollar because some highly paid executive you know just lost their job and the big bonus she was expecting, and she has to fire sale the home, you need to consider the payments on a $1 million property will be in the neighborhood of $6,000 per month. Now, if you can afford to make that payment indefinitely, then maybe go for it. Otherwise, I'd suggest you pass. It could take a lot of time and monthly payments before you could resell or rent that property. It falls on the lower end of the bell curve. Number 3, cash flow. In addition to picking the right type of property in the right market, it's important that you should be investing in properties that will likely cash flow positively even in the middle of economic fluctuations. Rent is the great equalizer. Home values may rise and they may fall, but rent is fairly stable. And it's the fairly stable part of the equation that rises at approximately the same rate of inflation, typically at 1 to 4% annually. Rent will keep you in the game when home values drop, and it will be a great added value as prices rise. There are two perspectives we like to look at when considering cash flow. Number one, cash on cash. This is the direct correlation to the total amount of cash you spent getting into a property, including down payment, closing costs, rehab costs, and any fees associated with getting it rented out. Total out of pocket, or TOP. You then take your annual net cash flow after all expenses and divide it by your TOP. This gives you your cash on cash return on investment. If you're somewhere between 4.5% and 8.5%, you're doing great, and you can feel like you have a very good single family investment property. The second way we like to look at cash flow is what we call combined cash on cash. This includes your cash on cash ROI that I just described, plus you'll add in the principal paid down when you make your mortgage payment, as well as adding back in depreciation expense. You can expect this number to fall between 11 and 15%. Even in our current economic situation, you can expect to earn these levels of return. The last 2 points we want to share with you are probably the two questions we are fielding the most right now, and the two questions that our teams in the field are addressing every single day. The first question is of home values and home prices within the current economy and the current market. So home prices and home value. Right now, the question of what will happen to home values is the million-dollar question. Ultimately, no one knows the answer. But what we do know is that having a roof over your head is not a luxury. It is a necessity of life and everyone needs one. We also know that based on supply and demand, there is still a significant shortage of affordable housing for the middle income earners across the US, and in particular, the markets where DFY is positioned to help its clients. As such, there still remains upward pressure on affordable home prices. As of today, our boots on the ground team members are seeing that in some areas like Orlando, home prices have softened just a little. Builders are sitting on some inventory and are anxious to sell and are willing to cut a slightly better deal than just a few weeks ago. But when I say slight, I mean slight. In some instances, on cash offers of multiple properties to one buyer at a $210,000 purchase price, the homes might be discounted by $10,000 and a refrigerator thrown in for good measure. In other markets, as of yesterday, we are seeing more than 8 offers on one property, with a final and best offer above asking price being the case. So we have a little bit of a mixed bag, and each zip code in each city is a little different. This fact is one more reason our boots on the ground information is so critical and essential to buying the best property for using single family investment strategies. Getting data and info on cable news or online news sources is way too generalized to be useful at the buying level that we're talking about. In fact, our local property management teams are reporting increased activity and a more committed tenant who wants to lock in one of the basic necessities of life right now, shelter, so they don't have to worry about not having a place to live while weathering this economic storm. The conversation of tenants and rent collection is probably the single most important question we can address, and we benefit by having mounds of real-time, real-life data on this point. With our teams, our property managers, and our clients, we are getting a live feed on the current rental and tenant situation, given the fact that DFY clients have thousands of rental properties being managed through our property managers. Number 5, collecting rents. While you may hear some speculate in a column, on a blog, or in the news media about the impact the unemployment rate or the eviction moratorium for tenants might have on property owners, we have current information from our boots on the ground property managers who have real life, real current, actual real-time data, what is in fact happening with our client investment properties and their wonderful renters. Rent collection is probably the number one question and concern for all property owners today. More than 6 million people have lost their employment in the last 3 weeks. This is such an unbelievable scenario that I can hardly digest what it means. Fortunately, there are currently numerous resources and safety nets available to help tenants maintain their rent payments, thus facilitating an environment where even though a tenant has lost his job due to the coronavirus pandemic, he should be able to continue to pay rent and almost all of his important expenses. Normally, when someone loses their job to no fault of their own, they become eligible for state unemployment benefits of around $400 a week for a few months. That weekly number can be a little less or a little more based on the state in which they live, but $400 is a good average. $400 a week, or about $1,600 a month, is not enough to maintain rent while still maintaining the ability to keep food on the table and keeping the gas and lights on. With the recent stimulus package approved by the federal government, that $400 a week average state benefit is getting an additional $600 of employment income each week for the next 4 months from the federal government. In other words, if you did or do have a tenant whose job situation was impacted by COVID-19, They will now be receiving checks supplemented by the federal government to the tune of $1,000 a week or around $4,000 a month. This is likely enough for most people to maintain their basic living expenses, including rent payments. And that does not even count the thousands of dollars of one-time stimulus checks that are going out soon. There is also the Paycheck Protection Plan from the CARES Act that has been provided to small businesses to keep millions of more jobs from being lost. It is expected that this help will ensure fewer people will lose jobs in the first place, which means more renters being able to pay their rent. After talking to our property managers to get real-time updates, our property managers are seeing approximately 10% of their tenants being in a temporary situation where paying rent in April is an issue. As the month progresses, they are expecting that number to drop as unemployment benefits are secured. Now, there are additional local assistance programs available in each market, and our property managers are helping connect tenants with those resources when needed. But the question still remains, what if you do have a tenant that, for whatever reason, the 2 or 3 safety nets available to them in order to keep an income are unavailable to them? Meaning, what if you truly do have a tenant that does not have the ability to make a few months of rent payments to you? For property owners, there is some good news. The government has taken steps to provide mortgage assistance. Currently, in many states and with numerous lenders, investors are eligible for mortgage forbearance on their investment loan if their tenants are affected by COVID-19 and they're not making their rent payments. Options often include deferring mortgage payments for 3, 6, or even 12 months, during which time there are no penalties or negative credit consequences. Interest may accrue or be deferred. You can view more details of these mortgage deferment programs on our website under the COVID-19 banner. While you may be experiencing a fear or uncertainty rooted in this current pandemic, there is a lack of overwhelming proof that a simple conservative investment into high-demand, middle-class income real estate will have any long-term negative effects. On the contrary, investing in real estate the right way in the right markets may be better than it has been in the last several years. The economy was about the healthiest it's ever been before COVID-19 hit and the government shut the country down to help protect our lives and our health. The economy as a whole is experiencing a kink in the hose right now. But as life returns to normal and people go back to work and the economy reopens, we believe there will be a release in that kink in the hose. Those who are taking steps and preparing to invest now are those who may find the best opportunities and will be those who will likely experience the greatest economic upside as soon as America goes back to work. If you have any questions or like more details on any of these 5 questions or additional tips or updates that we provide today, please visit our website at dfy-realestate.com or give us a call at 801-204-9061. Stay safe, stay healthy, and stay economically engaged, and we'll get through this together.